Hello and welcome to today's video. In our last video, we went through the huge amount that you need to know before you even think about investing in single shares. I provided a long laundry list of all of the things you really must understand in detail before you do that. And I made the point that the reason so many people lose money in the stock market is because very few people learn everything you need to learn to do that safely and with sufficient skill. Please do check that video out if you haven't already, because this stuff is hugely important if you want to invest in the stock market and minimize the risk that you lose money, as so many people do. I then went on to explain how this need not matter and should not prevent you from getting involved in stock markets, however, for the simple reason that you can buy entire markets. This is much easier than buying single companies and has a number of key advantages too. The evidence shows that the majority of investors underperform the market, which means that if you just buy the market, you will increase the chance that you do better than most investors by definition. As I've also shown in a number of our previous videos, making market returns over a long period of time can have a fantastic impact on your chances of becoming wealthy. So today, let's look at how you go about doing this, at how you buy entire markets. And the first thing we need to explain is the idea of an index, the plural of which is indices. An index is simply a method of measuring a financial market in some way. You'll most likely have heard of the FTSE 100, since it tends to be referenced by the British press every day. And as a quick aside, I confess that I do find it exasperating and fundamentally ridiculous, almost to the point of being comical, that the Today in the Market section of most British news bulletins takes about 30 seconds to tell you what the FTSE 100 and the pound did today, and that is it. Is it any wonder that so few people understand anything about financial markets when our news provides us with two such pointless and meaningless data points every day, and that is all they do? Anyway, moving swiftly on and back to the idea of indices. The FTSE 100 is an index. It's simply an invention of the London Stock Exchange, which adds up the price and size of the biggest 100 companies in the UK in order to generate a number, and that number is known as the level of the FTSE 100. And the point of this is to give investors all over the world a rough snapshot of how well the British stock market is doing, and to a certain extent, how well the British economy is doing by extension. The FTSE 100 doesn't represent the entire British economy, but it is a good proxy, since the top 100 companies tend to represent about 80% of the entire value of the stock market and a reasonably large percentage of the value of the UK economy as a whole. The 100 companies in the FTSE 100 are currently worth about £2 trillion, which is not far off the value of the UK's annual gross domestic product, for example. Importantly, the FTSE 100 index does not tell the whole story about the economy, because there are hundreds of other smaller companies listed on the London stock market, as well as millions more private companies. So those are companies that are not listed on the stock market, which operate in Britain. The UK's top 100 companies also do a great deal of their business overseas. Nevertheless, to some extent, the index is a useful indicator of the state of the UK economy. Every country in the world that has a stock market has several stock market indices. These were originally created and managed by the companies in charge of those stock markets. So as well as the London Stock Exchange, these included the New York Stock Exchange in America, Deutsche Börse in Germany, Nikkei in Japan, and lots of others all over the world as stock markets developed. Examples of indices you may have heard of include the Dow Jones, Nasdaq, and S&P 500 in the US, the Nikkei in Japan, the Hang Seng in Hong Kong, the DAX in Germany, the CAC in France, the ASX in Australia, and so on. And it's important to understand that indices are somewhat arbitrary constructs. Each national stock exchange chooses to include different numbers of stocks in their main index, and then they cut their market up in a variety of different ways, providing other additional indices for the investor to look at. So in the UK, there's the FTSE 250, for example, which includes the next 250 companies below the FTSE 100 in terms of size, and together those make the FTSE 350. Despite being arbitrary, indices are very useful to us as investors. If you want to make sure that you own the 100 biggest companies in the UK, or 500 of the most important companies in the US, for example, you need look no further than the FTSE 100 or S&P 500. In recent years, independent financial information firms such as Reuters and Bloomberg have created their own indices for a wide variety of assets, as have certain divisions of investment banks like Morgan Stanley, Barclays, and Goldman Sachs. And what this means is that you can now find indices for pretty much any asset or country in the world. Bonds, commodities, big companies, small companies, and stock market sectors such as banks, telecoms, or pharmaceutical companies. The reason this is important for our purposes is that as a private investor, you're generally able to buy these indices using a related fund. And there are various different types of such funds, which are generally called tracker, passive, or crucially, exchange-traded funds. Today, it's possible to invest in pretty much anything that you might think of using an exchange-traded fund or ETF. To give you an idea of the insane choice out there nowadays, in an article from August of 2019, James McIntosh of the Wall Street Journal wrote that there are indexes and ETFs for everything. No one knows exactly how many, but it is certainly in the millions. And on the one hand, this is actually quite amazing. It's literally never been easier in the whole of history for you to implement any investment idea you might have. This is hugely powerful, and it's yet another example of why human progress is the most important investment theme of them all. But set against this is something called the paradox of choice. And this is the basic idea that the more choice you have, the more likely you are to suffer indecision and not actually do things and get the results you want in life. Whether you're talking about choosing a song on Spotify, a movie on Netflix, or arguably rather more importantly, what to do about your investments. For most people, the best way to get around this problem is to look to keep things as simple as possible. And to do this, arguably the easiest approach is to look to invest in one of the very biggest and most liquid stock markets available to you in the world. Arguably the best known of these is the S&P 500 in the US. This index includes fully 500 of the biggest companies in America, including all of the big names you'll be more than familiar with, such as Apple, Google, Tesla, Facebook, Microsoft, and Amazon, and several hundred others, some of which are also household names like Visa, MasterCard, McDonald's, and so on. As I've shown in several of our previous videos, the S&P 500 has returned more than 10% a year on average for the last century. It's very important to understand that these are average returns over long periods of time. That 10% does not come smoothly every year like an interest rate. Some years the S&P is up as much as 30%, and every few years it crashes and can fall a long way. To achieve that 10% return, you have to be very clear about this, and you have to be investing for the very long run to ride out the volatility along the way. We're going to look at this idea in more detail in our next video when I look at the idea of how to invest so that crashes don't matter. And it's also important to understand that past performance is not a reliable indicator of future performance. This key disclaimer is in the description bit of our YouTube channel below, but it's so important to us to make that point that I'm also saying this here in the video itself. The fact that the S&P has averaged more than 10% for a century is great and obviously quite exciting, but it's no guarantee that it will continue to do so, and it will certainly take backward steps every few years. But, as I've said before, the reason why it has delivered these sorts of returns over very long periods of time is quite simply because of human progress. In the last century, we've enjoyed wave after wave of astonishing forward progress technologically all over the world, whether that's been the development and spread of the automotive industry, aviation, shipping, the advent of the silicon chip, the internet and smartphones, or very recently, the explosion in the biotech industry, artificial intelligence and machine learning. The list of these sorts of developments in the last 100 years is very long indeed. And this front and center is why stock markets go up over time, from bottom left basically to top right. If you believe in human progress, then it's probably a good idea to invest in it if you want to become wealthy at least. And for what it's worth, if you believe that human progress is likely to come to an end as we descend into some kind of World War III, which I suppose it feels a bit like at the moment, you may as well invest anyway. First, because wealthy people have far more power to navigate awful situations like war than people with no capital. But also, actually, because if we are unlucky enough to experience some kind of nuclear Armageddon in our lifetimes, there's actually nothing you can do about that, and your investment returns up to that point will be largely irrelevant anyway. You may as well invest whatever happens, because if things continue to develop as positively as they have in the last 2 centuries, you will be far better off if you do. And if our worst fears are realized, it won't really matter either way. This is what traders call an asymmetric bet. There's far more upside to investing than not investing, whichever scenario plays out. As I said in a previous video, pessimists sound smart and optimists make money because optimists are more likely to invest. So one option is to invest in the US stock market. It's done very well for the last century, as we've seen, and this is very easy and inexpensive to do and tax efficient if you're a UK citizen. This having been said, there is no guarantee that all the best and biggest companies in the world in future will come almost entirely from America. The period since the end of the Second World War has been characterized by American exceptionalism, and the US stock market has led the charge for some time as a result, and particularly in the last 10 years. But as any smart 10-year-old will tell you, what goes up must eventually come down. And when you look at the state of US politics at the moment, you do have to wonder whether the US will be quite as dominant in the next century as it has been in the last. This is a view shared by some very smart people, including Ray Dalio, founder of Bridgewater, the biggest hedge fund in the world. And he's made the case that America's best days may be behind it in his 2021 book, The Changing World Order. This being the case, might it actually be a good idea to widen your net a bit and look to invest in more than just the United States? There are already a good number of companies from places like Asia and Europe that are in the top few largest companies in the world today. These include Taiwan Semiconductor Manufacturing Company, or TMSC, in Taiwan, Novo Nordisk in Denmark, which has become very famous recently because of its weight loss drug, Tencent in China, LVMH in France, Samsung in Korea, ASML in the Netherlands, and quite a few more elsewhere. Given how dominant the US has been for the last decade, but given the direction of travel in places like China, Europe, India, Latin America, the Middle East, and Africa too, might it be better to hedge our bets a bit? And the good news is that this is also easy and inexpensive to do. You need look no further than two companies which provide large global stock market indices, MSCI and FTSE. MSCI, which stands for Morgan Stanley Capital International, is a company which makes indices. And their MSCI World Index is made up of around 1,500 of the biggest companies in the world from all over the developed world. They also have their MSCI All Country World Index, which includes not far off 3,000 companies, because it includes ones from the developing world as well. And then there's also the FTSE All World Index, provided by FTSE, the Financial Times company, which includes even more companies from all around the world. It includes those from the developed and the developing world, and it has more than 4,000 in the index at the time of writing. You can invest in exchange-traded funds for all three of these indices, thus securing exposure to thousands of companies from all over the world and to human progress wherever it might come from. I think there's a good chance that at least some of the success stories of the next 10 or 20 years might come from places other than the US, and I think there's some decent evidence for this position. That, of course, doesn't mean I will be right. For what it is worth, though, American shares make up a significant chunk of all of these various global indices anyway. So to a certain extent, you can have your cake and eat it here, given that you'll still have exposure to those big US companies should those large American companies continue to dominate. Funds which own indices for you are a fantastic and powerful innovation, particularly when you consider that you can put as little as £25 a month into more than 4,000 companies. They're also a relatively recent innovation. The first big ones were launched in the 90s, and other big markets followed in the early noughties. They've grown enormously in the time since, but all too few British adults are broadly aware of their existence and making use of them. In a future video, we'll look in more detail at precisely how you go about investing in such things. And I don't want to do that today because before we do that, it's really important to cover a number of other key topics which will help you reduce the risk that you lose money in such things. The very long-run returns of these stock market indices can really help you become wealthy, but it is super important to understand that such things can and do crash every few years. Before you put any of your hard-earned money to work, it's vital to understand how to deal with that reality and how to invest so that crashes don't matter. We're going to cover this in our next couple of videos when we look at 4 crucial ideas you need to understand before you get involved in this kind of investing, in any kind of stock market investing. And these are investing for the long run, and ideally the very long run, investing regularly each month and automating your investments, ignoring the news and sticking to your guns over very long periods of time, and also using an elegant approach to investment called 100 minus your age. So we'll cover all of those things in the next few videos. And if you want to ensure that you're one of the first to see these videos when they're published, and as we go through these next few key steps, please do click the subscribe and bell buttons if you haven't done that already. And please also do share our videos on social media if you share our belief in how important financial literacy is and how important all this stuff is for everyone, and indeed, most particularly for British society. So until next time, as always, I wish you the very best, not just for your finances, but for life in general, and I'll see you in the next video.